Welcome back to the deep dive. Today we're going to unpack the sources you've shared to really understand yesterday's key structural movements. And these signals are interesting because they're less about what's happening in the clouds and a lot more about what's happening, in the ground. We have a mix of sources today. We're looking at high-level M&A, global energy policy, and even some really specific city-level planning decisions. It feels like the digital economy is running headfirst into the physical world. So, before we get into the details, what's the simplest way to summarize yesterday's world? What was the main vector?
Yesterday was really defined by a collision between accelerating digital demand, this just insatiable hunger from AI and very concrete physical limits. The critical global bottleneck it's moved. It's no longer just about software models or even about manufacturing enough GPU chips. The primary constraint is now physical utilities. It's institutional friction. Specifically, it's about power, land, and the sheer capacity to build things.
That's a huge shift. Okay, let's start with a massive financial signal that seems to prove this is now a capital market reality. Our first deep dive. SoftBank's roughly $4 billion acquisition of Digital Bridge.
Right. And what's so remarkable here is that this isn't about the AI models themselves. The capital is focusing explicitly on the physical prerequisites for AI.
But hold on, hasn't the competition always been about power and cooling to some extent? What makes this moment right now structurally different?
It's the scale and the velocity. 5 years ago, companies were optimizing. Today, it's just a desperate search for capacity. The AI industry has entered a completely new phase. The competition for who has the best model is becoming secondary to the competition for the physical foundation it runs on. A chip is kind of useless if you can't find a site with 100 megawatts of reliable power.
I see.
So the real fight now is for the underlying assets: available power connections, pre-permitted land, cooling solutions, and of course, reliable fiber.
So with SoftBank buying Digital Bridge, they're not just buying a fund, right? What exactly are they getting control of?
They're folding in this huge, sprawling portfolio. It gives them direct control over infrastructure like cell towers, fiber lines, and, crucially, data centers that are already strategically located near power access points.
They're securing the choke point.
Exactly. They're buying the bottlenecks.
So if the big money is literally buying the ground that AI sits on, what does this finance X, power X land restructuring signal for the rest of the market?
It confirms the bottleneck is shifting. It's moving away from the silicon layer, which, is becoming more abundant, and onto the utility and construction layer, which is rigid and slow to change. Practically, this means land values near major grid substations are just skyrocketing. We're seeing new financial products being built around futures for utility capacity. This $4 billion move is a huge global signal.
The signal that what's coming next is
A sustained period of massive M&A focused entirely on infrastructure, not tech. The path to AI profit now runs through concrete and copper wire.
that focus on physical resources connects perfectly to our second deep topic. The changing energy strategy of big tech itself. If SoftBank is buying the land, where is big tech planning to get all that power?
And this is a really critical pivot. We're seeing corporate strategy begin to override previous environmental commitments, all because of these immediate physical constraints.
So why the sudden shift? Why this all of the above strategy happening right now?
Because the power demands of these new data centers are just completely overwhelming the existing grid. We've moved past abstract conversations about sustainability targets in 5 years. The constraint isn't the theoretical availability of clean energy down the road. It's acute grid constraint and the need for immediate supply. Right now, these data centers have to be online next quarter, and the grid can't handle them.
And what does all of the above actually look like in practice for these companies?
It means big tech procurement is still prioritizing renewables, which they want, but they're also aggressively pursuing new capacity from natural gas and even nuclear sources. They've decided they have to secure capacity immediately, even from sources they previously deprioritized. The economic cost of an idle, unpowered data center is just so much greater than the cost of the energy itself.
And this has a strong real-life impact on you, the listener. If these massive companies are muscling into local energy markets this aggressively, what happens? What should we expect?
You get what we call high membrane tension at the local level. It's like an intense political pressure cooker. You have big tech on one side, local government in the middle, and then residential consumers on the other.
And that plays out how?
You see it in fights over city permits, new rules for transmission lines, and of course, potential hikes in electricity rates, even localized outage risks for people already living there. But it's not just about power. The sources also point to the rise of something called the water stress factor, or WSF.
Okay, you're going to have to unpack that one for us. WSF. Why is that suddenly part of a conversation about AI?
The WSF is just a metric that tracks water availability versus demand. It's suddenly critical because of indirect water use. The huge amounts of water needed to cool the gas-fired power plants that are supplying these data centers, that's becoming a structural constraint.
Ah, so power and water are now linked.
Inextricably. It creates a double constraint on where big tech can even build. The urgency for electricity is now creating an urgency for water.
A deep constraint indeed. And all of these infrastructure shifts are happening against the backdrop of global energy prices. That brings us to our third deep dive, OPEC Plus holding the line on its production policy.
And oil is still foundational. It underpins the cost of everything else we've talked about, moving construction materials, logistics, all of it.
Was this OPEC Plus decision surprising? And why are they being so cautious right now?
It was expected, but still very significant. They're being cautious because of supply uncertainty. They're worried that if they ramp up output too aggressively, they could create a supply glut and undermine the price.
So their goal is stability.
Their goal is a predictable, high floor under the price, even with robust demand.
So what did they actually decide on output?
The group is maintaining its current production policy. No acceleration in output through at least the first quarter of 2026. They're sending a very clear message. They prefer a stable, higher price over just chasing market share.
Now, you noted this decision has one of the strongest real-life impacts of our topics today. How does a stable oil price affect me, the listener, beyond just what I pay at the pump?
Because oil is so fundamental, it powers the supply chains, it feeds the gas power plants. Keeping that price floor high means sustained costs for fuel, for transport, for basically all consumer goods.
It sets a baseline.
Exactly. If logistics and energy stay structurally expensive, it really limits the policy room for governments to fight inflation without slowing down the economy. It kind of cements the cost of living at a higher level.
That gives us a really solid structural picture.
Yeah.
So we've got the macro forces. Now let's quickly map the localized friction points, what you call the global membrane tension. Let's run through 5 of these. First up, Indonesia and its new FX retention rules.
Right. So Jakarta is tightening the rules. It's requiring resource exporters, think coal, nickel, to hold their foreign exchange earnings inside the domestic financial system. This is a resource X currency X national finance knot.
And what does that not imply?
It's resource nationalism meeting monetary policy. It forces cash from the global supply chain into local banks, which could stabilize their currency. But it also might mean those companies slow down investment in new supply for critical materials like nickel because their cash is tied up.
Okay, from Asia to South America, Argentina is adjusting its exchange rate.
Yes, they're shifting towards an exchange rate band that's tied to inflation. It's an institutional move. It definitely introduces some short-term friction, but the goal is long-term predictability.
Which affects?
Profitability for anyone extracting resources there. And it affects supply chain decisions, like how long you're willing to sign a contract for.
Now over to the Middle East. Abu Dhabi has announced plans for a huge integrated AI campus. 5 gigawatts, they're saying.
This is a really powerful city-driven shift. They're not just building a data center. They are combining power generation from nuclear, solar, gas, with the data centers, with research, with talent. They're designing themselves as a computational capital port.
And the immediate effect.
Strong, immediate demand pressure on advanced server and networking equipment worldwide.
Meanwhile, here in Europe, Dublin, a major data hub, is getting much stricter with its power rules.
Yes. Data centers there now face really strict requirements for new grid connections. They're mandating on-site power generation, storage, and even contributions back to the system. This is what we call the City OS pushing back.
What does that mean, City OS pushing back?
It means the city government is done with unlimited expansion. They're telling big tech, your growth is now tethered to your ability to guarantee grid stability. This creates friction, and you should expect this exact fight to spread across other European hubs like Frankfurt and Amsterdam.
And finally, let's go to Western Africa, Lagos. Equinix is moving ahead with a new data center plan, LG3.
This enhances the tradability of the city's operating system. What that really means is the underlying infrastructure, the power, the cable landings, the local talent is all improving. As a key connection point for the region, this investment boosts the utility of Lagos as a hub, no matter what's happening with national politics.
So when we pull all this together, the 3 deep dives, these 5 localized signals, what's the overall picture that emerges?
The picture is clear. Acceleration, driven by AI demand and huge capital M&A, is colliding with rigid physical constraints, power, land, and institutional rules. The major friction point isn't in the cloud anymore. It's in the ground. It's in city council meetings. The big structural movements now are all about securing the physical, political, and financial prerequisites for computing at scale.
So for those of us building our own world OS, trying to see the next big choke point, what should we be paying attention to over the next year or two?
The critical thing to watch is the convergence of what you could call a triple constraint, where the tension is going to build up most intensely. That's power connection, which is grid capacity, cooling, specifically water stress, the WSF, and local regulation permits and pricing.
That triple threat.
Exactly. This constraint means that local planning, which used to be a kind of slow, boring topic, is now a high-stakes global political issue. Every city is going to have to decide its allowable ceiling for AI expansion.
That really makes the shift from silicon to soil tangible. Okay, here's a final thought to take with you. Consider how quickly the economic value of a cutting-edge $100 million AI model degrades to zero when its power source is a 20-year-old municipal substation that fails. That relationship, the instantaneous value of the virtual versus the age of the physical asset holding it up, that's the new structural constraint. Thank you for joining us for this deep dive. We'll be back tomorrow to map the next structural movements shaping your world.